using a process called civil asset forfeiture. Civil asset forfeiture is one of the most controversial areas of American law, and it deserves special attention in this conversation. Under civil asset forfeiture rules, the government does not have to prove you did anything wrong in order to take your money. They just have to show that there is probable cause to believe the money is connected to a crime. Once they seize it, the burden shifts to you, the account holder, to prove your innocence and get your money back. This process can take months or years, requires hiring an attorney, and in some cases costs more in legal fees than the amount that was seized. The third thing, and this is something a lot of people do not think about, is to avoid any appearance of structuring, even if you are not intentionally structuring. If you need to move a large amount of money, do not break it up into multiple smaller deposits just because it feels less risky or because you are not sure about the rules. Making multiple deposits that are just under $10,000 is one of the clearest red flags in the banking system. If you have a legitimate reason to deposit a large sum, deposit it all at once. Keep your documentation and let the currency transaction report be filed. A single properly explained $10,000 deposit is far less problematic than three suspicious $9,000 deposits. Imagine waking up one morning, checking your bank account, and finding out the government has been watching every single transaction you make. Not just the big ones, not just the wire transfers or the stock trades. Every single deposit, every single withdrawal, every time you move money around. Now imagine you are retired, living on a fixed income, managing your savings the way you have always done, and suddenly you find out that a new IRS rule could flag your account, freeze your funds, or trigger an audit, all because of a number. The number is $10,000, and starting in 2026, this number is going to mean something very different than it ever has before. And one of the things that has long triggered suspicious activity reports is a practice called structuring. Structuring is when someone deliberately breaks up large transactions into smaller amounts specifically to avoid triggering the $10,000 reporting requirement. For example, if someone deposits $9,500 one day and then $9,000 the next day, and then $8,000 the day after that, the bank is legally required to report that pattern even though none of the individual deposits hit the $10,000 mark. That is structuring, and it is actually a federal crime. A list of people the IRS wants to take a closer look at. Not because she did anything wrong, but because the way she moves her own money now looks suspicious to an automated system that does not know her name, does not know her story, and does not care that she spent 35 years teaching third grade. This is the reality millions of seniors across America are about to face, and most of them have no idea it is coming. The first and most important thing you can do is keep records. Keep thorough, organized, accessible records of every significant financial transaction you make. If you sell your house, keep copies of the closing documents. If you receive an inheritance, keep copies of the estate documents and any bank records showing the transfer. If you liquidate a retirement account, keep the statements from your financial institution showing the distribution. If you make a large gift to a family member, write it down, note the date, the amount, and the recipient, and keep that documentation with your tax records. The IRS cannot flag you for something you can clearly explain. The problem is never the transaction itself. It is the lack of documentation to explain it. Is the interaction between the $10,000 reporting threshold and the reality of everyday senior finances. Think about this. If a senior is selling personal property, furniture, jewelry, a car, collectibles, those are often cash transactions. If they are a landlord collecting rent payments from a tenant, depending on the rent amount and how it is paid, they could be receiving reportable sums regularly. If they are helping a family member by temporarily holding money, depositing it, and then transferring it, something that might seem like simple family financial management, that can look extremely suspicious to an automated system. The IRS has received significant new funding, right? We are talking about billions of dollars in additional resources, and a major portion of that funding is going toward modernizing their data analysis systems. What this means in practice is that the IRS now has far more sophisticated tools to analyze bank transaction data that is already being reported. They can cross-reference your deposits against your reported income. They can flag discrepancies automatically. They can identify patterns that suggest unreported income or unexplained cash flow.